Hey everybody, happy Thursday. Hope you're doing well. We got a lot going on this week. We had a terrible jobs number to close out last week and kind of start us off here in our weekly update. And inflation this week seems to be the buzzword out in the news media. So we'll talk a little bit about that as well. My name is Brandon Steele. I'm a financial advisor with Mainsail Financial Group just here in Bellevue. And we really want to bring this weekly update to you every week, just kind of share some of the top stories, some of the top trends that we're watching in the markets, and make sure to bring that to you in kind of a quick, digestible version. If you are local here, hopefully you're enjoying this weather. I think this weekend's supposed to be in the mid 70s or so again. So I know I will either be on the golf course or dog park or both, but it's been great to see this weather come out and everybody come out with it, and may have a little something to do with with the inflation discussion we'll be getting into here shortly. But I hope you're enjoying the springtime, and hopefully we got a lot more sun to come. So let's start by talking a little bit about the jobs data that came out last week. So on Friday last week, we had a terrible non-farm payroll report. We talked a little bit about the ADP employment report last week. And then on Friday, we have non-farm payrolls, which was supposed to be a huge number. The expectations were somewhere around 1 million jobs added for the month of April. And unfortunately, we added just over 200, like 260,000, something right around there. So it was a huge disappointment. I mean, we had these just ridiculously high expectations and just got shot down very quickly. Through that, we didn't really see a lot of market movement, honestly, until we jumped into this week a little bit further. And on Tuesday, we had some jolt data, like some information on job openings come out, and it was really bad. And then we also had some inflation concerns starting to roll out. And so Tuesday to today's Thursday, Tuesday, Wednesday, Monday to some degree, were pretty bad days in the market, Wednesday especially, because on top of that, we also had some information around consumer price index. So we had this really big storm. I mean, we had terrible jobs numbers, we had inflation picking up, and then we also had the side effect of inflation and how that might impact or influence the interest rate market. So I'll talk a little bit more about that here in a minute. But basically on Tuesday, the CPI numbers came out at about 0.9%. So much higher than expected. I think we're expecting around 0.3. This is the first really big jump that we've seen in this. And, obviously it got people talking. And it obviously led to a big dip in the markets as well. It's been very interesting. We've talked about inflation forever, and we've all seen it. You go fill up your car at the gas station, and it's all costing us a lot more right now. Every time you come home from the grocery store, you're realizing that, carton of milk is costing a little bit more. I think we've all noticed it, but it's now finally getting kind of pushed through to the actual measured numbers, I should say, excuse me. Lumber has been a big part of that. I mean, you name it, right? Everything that we buy has really been growing, and it's not anything new. The difference is now some of the stuff that we weren't buying when we were in lockdown is starting to increase as well. And so, the whole number kind of picks up. So I know we all feel it. And certainly, now we're starting to see it. So what has been a big concern about this inflation issue is that a lot of times when there's inflation expectations, the interest rate market starts to go up. Interest rates start to increase as well, in expectation of higher prices in the future. So that was really what I think we saw a lot of concerns over on Tuesday and especially Wednesday, was wondering, like, what does this mean? Is the Fed now going to start raising interest rates? Even without that, is the market going to do their own thing and see interest rates rise? And we saw the 10-year go over about 1.7. We saw a lot of the realities actually kind of come through in the markets as well. The Fed has come out and kind of said, basically, we don't plan on doing anything. They keep saying it's transitory. Whether that's true or not, we will see. But I do think it's going to be a little longer term inflation than the Fed may believe. But I think the challenge is once this gets started, there's a lot of conversation about the Fed being able to control it. And I just don't know how that's really the case. So keep an eye on inflation, because I don't, historically, it has not been something that we can just kind of put the lid on and seal it up. Inflation is something that kind of starts to go and has a little bit of a compounding effect to it. And so it is important to watch. And basically, in our question of the week, we'll talk a little bit about how interest rates affect the market, higher interest rates. But that's the gist of it, is we saw bad jobs numbers. We saw a lot of job openings. And then we saw inflation really start to work its way through, and the concern about what that means to the interest rate markets. So that is the weekend in a nutshell, as if it wasn't, that was a lot. On top of that, we had some good news come out today. We had initial jobless claims come out at about 473. So this is the first time. Last week's got revised up a little bit. So I believe this is the first time we're under 500,000 since all this pandemic craziness we've been dealing with. And then as we move into next week, get ready. We've got retail sales, which are going to be really important, and I think probably a pretty big number given what we're seeing on the inflation side of things. And then also very, very importantly, we have the Fed minutes on Wednesday. So this is where we can kind of really dig in and see what's going on there, and see what they're looking at, what they're considering as inflation and interest rates become to be kind of like the forefront of all the conversations we're having. Also, we're hosting a free online learning session coming up next Thursday, May 20th at 5 p.m. Pacific time. So if anybody wants to join us, we'll be talking about a lot of this in much more detail, how it relates to more broad planning strategies. And also, especially for those in Washington State, we'll be talking about some of the tax changes going on and ways to kind of position yourself for what's ahead there. So if you do want to join us, again, Thursday, May 20th, just go ahead and reach out. You can comment below, send us a message, and we can make sure to get that link to get you registered. Before next week, I do want to touch on the question of the week here for this week, which is very, very relevant given what we've just talked about through the last couple of minutes here. And the question is, okay, so we have inflation, and it's kind of driving a concern about interest rates, but how do interest rates really impact the markets? And I think this is really important to understand, because this is really what's going on this week and will continue to be a conversation for a while now. The reason that interest rates impact the stock market, and that's really what I'm referring to, I'm not talking about bond markets. One thing I will share is that interest rates rise, bond prices fall. So that is very important to pay attention to as well, especially if you're a conservative investor or have a lot in bonds. But higher interest rates also have a negative impact on stock prices. And there's a couple of reasons to that. Number one is, if you want to think about it this way, if you have two choices, stocks or bonds, right? Or let's say stocks and cash. And let's say cash is paying 10%. Like, you just put your money in a savings account, they're going to give you 10% a year. You might not be as inclined to go risk your money, right, and take the volatility of the stock market, because you're getting 10% already in a checking account or savings account, right? Now, if that same savings account is like what we're seeing today, and it's paying you 0 or very next to 0, you might, as an investor, be willing to take a little more risk on in the stock market in the hopes for better returns, right? Because we're getting 0 as an alternative, basically. Right? I'm speaking very conceptually, but this is a very important consideration, because that's a lot of what we've been talking about over the past months, is as interest rates are low, you've got a lot of investors willing to pay a lot more for stocks because there's not really another alternative, right? That might be the best option they have. They may be willing to take on more risk, pay a higher price in hopes for better returns. The second thing is how interest rates affect the velocity of money in the market. Right? When interest rates are low, money is cheap, money is free, money is everywhere. As interest rates rise, that becomes a problem. Money is now more expensive. Money moves a little slower. Money is harder to get. And so when we think about investments and businesses investing and things that they may be doing for the future, that slows down a little bit as well. So there's kind of two factors in that as interest rates rise and how they affect stocks or the stock market in general. And I think what's really important about that as well is that both what I shared about how interest rates rising affects stocks and bonds is one of the challenges we face right now. Is if interest rates do rise, that is a negative, may have a negative impact on both stocks and bonds. So it's important to really think about diversification a little bit better and risk management even more than you typically would, because normally they may move in opposition. So hopefully that's helpful. If you have a question of the week for us, I realize that one was in depth, but I think very, very relevant. Please do email us info@mainsailfg.com. And also, if you do want to register for the webinar, just reach out and we'll go ahead and get that link to you here to join us next Thursday on May 20th. Thank you guys so much. We will see you next week and have a great time, great weekend in the sunshine.